Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It is late July 2024. I want to talk in this video about money and inflation. See, these aren't new topics from me, but I think there are some things to say which are fresh and worthwhile. In 2020, I said that there's going to be a round of inflation, and in that I was in a minority in my profession, where most economists, most economic gurus expected quite a few years of deflation because of COVID. What I want to do today is to explain why I gave the forecast that I did make in spring and summer of 2020, using a feature of the economy that was present all through the previous 100 years. And then we'll see how this key feature of the economy that I'm going to focus on that justified my forecast, how it actually turned out in practice. And then I'm going to make a few remarks at the end about the future. I'm going to be concentrating on the American economy simply because of the quality of the data and the importance of America to the world. Now here is my first chart. This is the growth of money and normal GDP in the 100 years up to 2019, so just before COVID struck the world economy. You can see the two lines go up together. As a matter of fact, money rises about a bit more than 0.5% more than nominal GDP in this period. It's true that this doesn't say anything about causation. All the same, I believe that it was money, broadly defined, that was driving nominal GDP, not the other way around, with broad money being influenced by developments in the banking system, the USA's public finances, and so on. Now, this chart is on a logarithmic scale, so we're seeing more clearly the pattern of rates of growth over time than in the last chart. And you can see that the only period of falling money, significant period, coincided with the Great Depression of the early 1930s. And while it doesn't establish direction of causation, I think it helps us to think about the topic. Now, what some monetary economists then claim is that if there's a change in money of, say, 10%, then there should be a change in nominal GDP also of 10%. There's a kind of strict so-called proportionality postulate. Sorry to use long words, but a strict proportionality postulate that keeps these two series together. And as I've just shown you with these two charts, that's not a silly idea. Money, of course, revolves all the time. It has the velocity of circulation. I don't need to tell you, I hope, that there's this famous formula MV equals PT. Money times velocity equals prices times transactions. Well, is velocity constant? Which is what lies behind the proportionality postulate. No, it's not. Here is a chart of the velocity of broadly defined money in the USA over that 100 years. You can see that the velocity of circulation has gone down over that period. Part of the reason is that money is being used increasingly over this period for financial transactions rather than transactions in national income and expenditure. At any rate, strict proportionality doesn't hold. And perhaps I should worry about that if I'm making these claims about the importance of stable velocity, stable money hold behavior, and so on. Well, I'm just going to tweak the discussion a little bit. What we have in this chart is the change in velocity in a one-year period in the last 100 years, and I compare it with the mean value of the change in velocity over this 100 years. It's about 1% a year. Velocity goes down by about 1% a year, typically. You can see that we have this property of what's called mean reversion. There's that blue line, there's that sort of brown line in the middle, and velocity goes up and down. We knew this at the end of 2019. I knew it in broad terms. What that means is that if we have a period when velocity jumps, there's likely to be a following period when velocity falls. Or when velocity falls, there's likely to be a period in the next few years when velocity increases. To get back to this mean value, about 1% a year fall in velocity in the long run. I knew that. This is very important, the way I thought about the economy at that time. Let's then move on to look at the behaviour of money and nominal GDP in the USA in the last 15 or so years, including the COVID period. In early 2020, really through to around about June, July, there was an explosion in the quantity of money. At the same time, because of COVID restrictions, nominal GDP went down. So the ratio of money to GDP rose sharply and velocity collapsed. You can see that in this chart, it's rather obvious. I've just argued with you, that when you get these big changes in velocity in one direction, you'll get an offsetting change in the next few years. And that was critical to my forecast that inflation would go up in the next 2 or 3 years and not go down, as many other economists, including top economists at the Federal Reserve, Ivy League universities and so on, as those economists thought. Okay, well, in fact, in an article in something called the World Economics Journal, I said very specifically that there would be a reversion of velocity back towards the kind of figures seen through the 2010s in the next few years. So that starting from the situation in summer 2020 with this huge collapse in velocity, we'd then be seeing velocity rising again. If velocity is rising and there's still rather high money growth, what happens to inflation? It must go up. Well, it's now 4 years on from summer of 2020. We have those 4 years of data, and here is the chart. And you can see, lo and behold, I was right, that velocity collapsed, and since then it's moved back up towards where it was through the 2010s. That was critical to explaining why I forecast more inflation. I didn't, by the way, expect the process to be instantaneous. People, companies and so on, they hold their money balances. They use their money balances for all sorts of things, of course. Critically, they can use money to buy assets, houses, stocks and shares and so on. And that was much more a feature of the immediate post-COVID period than a great increase in inflation in shops, inflation over websites. This chart ends at the end of last year, fourth quarter of 2023. You can see the velocity is returning to the average of the 2010s. Still isn't quite there yet. So we had buoyant asset prices in 2021. We had inflation in consumer level coming through very much in late 2021 and 2022. We then, in fact, from around about spring 2022 had a collapse in money growth in the USA and elsewhere, by the way, but still that reversion to mean continues. This justifies, when we're thinking about this topic, always looking at what's happening to the growth of the quantity of money, and then also this ratio of money to GDP relative to the past. I think one has to confess, though, that the kind of forecast I've been making in the very recent last couple of years hasn't been so good. We saw money growth collapsing in spring and summer of 2022. I correctly said that this would make possible 2% inflation by the end of President Biden's presidential term, the end of this year, and that was pretty good. That was correct. I did make a good call on inflation in middle of 22, as I did in the middle of, spring of 2020. But I thought there'd be a recession, and that's been wrong. One of the puzzles about this period, when we've had this almost zero growth of money since spring, summer of 2022 in the USA, is that there's been surprisingly resilient asset prices and balance sheet strength. Usually when you get a halt to money growth, or certainly a fall in the quantity of money, that causes asset prices to go down, that weakens balance sheets, that then causes the recession. That hasn't happened on this occasion. If you look at this chart for house prices in the USA, you can see 2021, 2022 soaring house prices. That was the background that was caused by this leap in money growth, particularly in spring of 2020 and summer 2020. It also carried on 2021. But then after that, we had a complete halt to money growth. House price inflation stopped, but then picked up a bit. And of course, in this period, the last year or so, we've had very strong stock market as well. This hardly fits with a flat growth of money. I think looking back, part of the explanation was that there was still this overhang of money from the explosion of 2020. And I made a mistake in not recognizing how much it would keep the economy moving forward, The same kind of processes that we've seen in the United States have also been found elsewhere. In the Eurozone also, spring of 2020, we had a burst of money growth, not as extreme as in the USA, we had a burst of money growth. Velocity collapsed. This is the chart for the Eurozone. You can see the recovery back towards the level of the 2010s. UK as well. I could do these kind of charts for most economies, most developed economies, where all these central banks indulged in asset purchases which caused excessive money growth in spring and summer of 2020 when COVID hit. Looking ahead, we now are almost back to those ratios of money to GDP seen through the 2010s. If we still have continued zero money growth, then this is certainly a negative for both economic activity and inflation in the next 2 or 3 years. An important feature of the world economy at present is that in China, money growth is falling. That is on top of this flat money growth in the USA, Eurozone, UK, and so on. The message from that is that there won't be, inflation is not the story of the next 2 or 3 years. On the contrary, the most likely prospect is for beneath target inflation and possibly a bit of deflation. So that's my core message using this analytical framework. What I've done in this final slide is to summarize the key ideas at work here. Critical to the modern quantity theory of money is that the demand to hold money balances by companies, households, financial institutions is relatively stable, so that in the medium and long run we get this pattern of mean reversion of velocity to its trend value. This kind of analysis works for practically all economies at all times. It's an always and anywhere theory. May I conclude by saying that I don't think in this video I've said anything very alarming or very surprising, and in my view, this mean reversion of velocity back to its trend value is a critical feature of how economies work, and it should be basic to macro forecasting. I have to tell you, this feature does not appear in any modern macroeconomic forecasting carried out at central banks and universities, and that is one of the many things that are wrong with contemporary macroeconomics, and helps to explain why I was correct in making a forecast of rising inflation in spring 2020 when most of my professional colleagues were wrong. Thank you.